Now in Newstalk Lunchtime, we're joined by Steve Keane, Professor in Economics and Finance at the University of Western Sydney. He's in Ireland at the moment. And one of the few economists to have predicted the global financial crisis. You must take a cold comfort from that, Steve.
It is a cold comfort. It's the sort of thing where, yes, I got it right, but it's, compared to Einstein saying the atom can be split or Kepler predicting the return of a meteor, it's rather worse than the meteor lands in your backyard and it's called a financial catastrophe, and at least you saw it coming. It is cold comfort.
Here in the Irish context, and that's what you're over here to have a look at the moment, we are getting fed up to the teeth with the term austerity. It's being rammed down our throats at every available opportunity and is now beginning to bite at absolutely everybody in Irish society. No one is immune from this anymore. Is austerity the right phrase we should be using?
No, it's not. Austerity, you got a good point in saying it's the phrase, because the economists who didn't see this crisis coming are the ones who dreamt that particular phrase up. Now, you're following the economic advice of people who didn't see the crisis coming. So what are the odds they now had to get out of what they didn't even know was going to happen? And when they first dreamt up the phrase, they actually called it, and wait for this, you're going to love this one, reverse Ricardian equivalence. That's what they first...
That was never going to catch on.
That was never going to fly, So they then started talking about this is lovely, expansionary fiscal consolidation was their next go. Well, that's really a humdinger. And finally, they dreamt up austerity. And each of them have got this totally mythical idea that the first one, way back, explains where it comes from, believe it or not. And what they argue is that if the government sector cuts its spending now, that will convince people that there's going to be less taxes in the future. Therefore, they'll spend more, and austerity will cause an economic boom. I mean, pardon me, but what are they on and where do you get it?
I mean, the thing is, austerity is being sold to us here almost as a bit of a virtue at the moment. Do this and your economy will recover, and you're all being very good in Ireland. We get the odd little pat on the head from the Troika and we're told to continue. What do you understand what's happening to not just the state services and everything like that, but to everybody in society? I mean, who's not getting that?
Well, the people who come in and say this stuff about how you're doing the right thing, etc., they're living in an intellectual bubble. Which doesn't even see the role of private debt in the economy. Believe it or not, with a school of thought called neoclassical economics, which is where all this nonsense came from, dominates the profession. They don't even consider banks' debt and money in their models of how the economy operates. So when a crisis comes along caused by banks lending too much money and creating massive debt in the process and then leaving you with the debt at the end of the whole game, they haven't got a clue how it happened. They haven't got a clue how to get out of it. And what they're actually telling you to do is to spend less, earn less income, and pay your debts down. Now, I'm sorry, if you earn less income, your debts are harder to pay down. And what you actually need in this situation is, A, getting rid of the debts by abolishing debt that should never have been created in the first place. That's the direct action you should take. And match that with the government continuing to spend to make up for the fact that the private sector is reducing its spending below the level of income. That's what you need. They're doing the exact opposite of the necessary process, and they'll drive you back into recession again.
But we've a huge issue with debt in this country, whether it be state at large, personal debt, household debt. It's all giving a crushing strain on mortgage holders at the moment. I mean, Ivan Yates, who used to work on this radio station, described it very well when he said we're marinated in debt here at the moment. But should we be writing it off, and who gives us permission to do that? Well,
it come back to who's responsible for it being as big as it is in the first place, because one of the big myths that people get sucked into is believing the borrower is responsible for taking on too much debt. The borrower should have sensibly worked out what their income was, not borrowed any more than that, and the fact that they borrowed more, well, tough. You've got to live by your ethics, and you've got to suffer for the fact you borrowed too much in the past. That's totally back to the front, because it makes you look like the person who borrows is the person who's buying a bad product. The reality is, when you have a loan contract, the person who's doing the buying is actually the lender, the bank, and what the bank is buying is a promise from you to pay them an indefinite stream of money in the future in return for a lump sum of money now. And just in case you don't follow up, that's where they put the mortgage on the house with you. But the reality is, you've got banks with stuff full of PhDs in economics and God knows what else, who are supposed to be experts, and they're supposed to, and what's actually happened is they've accepted a promise to pay, from the Ma and Pa Kettles of the world with trivial incomes. And if you actually apply the old Roman principle of caveat emptor, let buyer beware, if they're that stupid to buy a promise of people who obviously haven't got the income needed to pay the debt the bank willing to give them, then the bank should suffer.
Well, the banks are, we're told the suffering of the banks is on an unprecedented level. Should the state has to rescue them on an almost monthly basis now at this point. But look, we're told that we can't have debt forgiveness. There's moral hazard. If you let one person off, then the guy down the road has to be let off as well. And what about the fella who has been paying all of his payments? So it's a very complicated procedure, and we've been told it's far too complicated for anything other than restructuring people going so that people could go bankrupt perhaps a little easier.
Well, I've actually come up with an idea that it's not simple, but it does work, and it covers all those various bases. I call it a modern jubilee. But if you want to put it in the vernacular that the economists have invented for this whole crisis, you might call it quantitative easing for the public. Because then a quantitative,
right.
Yeah.
We can't print our own money, so how does it work?
But so the state, that's your problem. You're stuck with the euro. Unfortunately, it's the Central Bank of Europe which is going to make it impossible for you to do this. But the Americans could do it, and so could the European Central Bank if they had the sense. And that's to simply say the credit system created too much debt. We made a mistake. We let them get away with financing asset bubbles, which they shouldn't have done in the first place. So we've got to reduce the amount of credit money in the economy and balance it by increasing the amount of government or fiat money. And the way you do it is, rather than giving the money over to the banks and say, please lend to the public, which is what they've been doing, which is obviously insane because the last thing what the public wants is more debt, give it to the public and say, if you're in debt, you're getting this injection, say 100,000 euros, everybody gets 100,000 euros. If you're in, so it's only a hypothetical figure, but don't hold me to it. You get that much money. If you're in debt, then your debt gets reduced by $100,000. If you still owe, you say you owe 150, you still owe $50,000. On the other hand, if you're somebody who's been a saver and you've bought bonds off the banks, which are toxic as we know, but you've bought those bonds, you get $100,000, 100,000 euro in cash. Now the bank then has to pay those debts down, so their cash reserves rise because they get the money from the debt being repaid. The value of their loans drops. That means that the toxic assets they gave you are worth, more realistically, worth less than what they were. The income stream will be less from them. But if that's the case, as a saver, you've got a cash injection you can spend out of anyway.
But is there not an inflationary risk with that? Would that not automatically happen as a result?
Not when you're balancing the whole. If you can balance it, you could target it so that it had a minimal. You only get a massive boost to inflation if you have a dramatic expansion in the amount of money for aggregate demand. Now, in fact, what you're doing with this sort of process, you're cancelling some debt and creating cash otherwise. You're reshuffling things. You're not actually creating a large boost in the amount of money in circulation. You're converting some of it from debt-based money to government-backed money. That's really the major role change. So in terms of an inflationary hit, there could be a bit, but it would be minor compared to the pain of deflation, which is what we're actually facing right now.
Steve, when you look at the Irish model and how everything is interconnected here, you had a property bubble that was linked to the banks, and then you had the banking collapse, which has led to austerity, which has led to a crisis for mortgage holders. It's all intrinsically linked. How quickly do you think Ireland can get out of this?
Well, you fortunately spent a fair bit of your time building some industrial base, and the old Celtic Tiger stuff about software development and so on gave you a fairly, you're not a totally damaged physical economy out of all this. It could be, I think, a matter of say less than a decade, say 5 years, to get out of it if you did it rapidly by reducing the debt. With this quick process I'm talking about. But if you wait for the slow process of people going bankrupt, having their debt written off that way, the whole grind that one person's bankruptcy leads to another and so on, you could be talking as long as the Japanese have been in a depression, and that's now going on to 20 years.
It could be 20 years before our economy is even close to what it was, say, 5 years ago.
Feasibly, because again, the only time we've been through a crisis like this beforehand is the Great Depression, with the same sort of thing, a speculative bubble driven by too much debt. Then the people started reducing their debt, and by bankruptcy and fire sales and stuff like that, you had deflation at various times running at 10% per annum in America when that thing began. And therefore the crushing burden of people repaying their debt and therefore spending less than they earn, meaning aggregate demand was below income, kept on going until you've had the whole Second World War process as well. And by the end of it, you'd gone from America having a private debt ratio at its peak of 235% of GDP down to 45%. And with debt that low, you had the booming economy of the 50s and 60s until they went right back up again. And now they got to the stage where American private debt peaked at 300% of GDP. Now, I don't know your Irish situation, but England on that front is worse than America.
You're listening to Newstalk Lunchtime. We're speaking with Steve Keane from the University of Western Sydney. Steve, you kind of hit it on the head there a while ago when you said we couldn't produce our own money. We can't engage in quantitative easing on our own because we're tied into the euro. But we are all consistently being told by our government that we have to play Europe's game. There's no other way of funding the state at the moment. So what the Troika says goes. Do they have any choice?
At the moment, politically, no. Which is why, but what you've got no choice, and you have at the same time you're having an intolerable situation imposed upon you, and you're not alone. Of course, we know Greece is in the same situation. Spain is getting there. Portugal will be there. Italy is going to have austerity imposed as well. Somewhere, someone's going to say we're not going to play this game anymore, and they're going to say it the same way they did in the 1930s with political coups and possibly military ones.
Look, you mentioned Spain. If they go, is the game over?
I think so. What they're simply trying to do is defy logic, because of my great friend Michael Hudson's put it with a wonderful little phrase: debts that can't be repaid won't be repaid. All you can work out is how you're not going to repay them. Now, of course, what they're trying to do instead is continue paying the debt by rolling it over, taking it on, having the public sector take on private debt, etc., etc. They're still trying to honour this stuff we simply can't pay. So at some stage it has to break down. That's the logic that they're trying to defy. I'm simply saying let's admit it now and do it now. But of course the main people stopping us doing that are the people who drafted the Maastricht Treaty, and they're the same bunch of economists who didn't think this crisis could happen.
Yeah, talking about economists, I've never encountered two economists who agree with each other. I'm not one of them, so I always have to listen and try and work out which one seems to make more sense. You make a lot of sense, Steve, I'll give you that. But when it comes to economics and the study of economics, it's not just about numbers. How would you classify it in this new modern era?
Well, it's basically a set of competing religions, fundamentally, where the dominant religion is a bunch called neoclassicals that believe the economy always heads towards equilibrium, and they believe they can model the economy as a barter system where you don't actually have money or banks or debt. Now, believe it or not, those people dominate the profession, and people can't believe that I'm serious about that. Search Paul Krugman on the New York Times and find his comments on me, and you'll find in that section I made a claim that you can't model capitalism without including banks, money and debt, and he said, I don't know why banks, money and debt matter in a model of capitalism. This is the Nobel Prize winner. That's how deluded they are. So, and what they have is a set of armchair philosopher notions, which they sort of have a priori logic saying, well, if I'm borrowing, if you borrow money, John lends to Steve, and therefore John's spending power goes down, Steve's goes up, and therefore there's no effect from debt. You can forget about debt, generally speaking. And I say, hang on a sec. When I don't borrow from John. I borrow from the Bank of Ireland, and the Bank of Ireland's debt assets goes up. My debt goes up. John's spending power is unaffected. The change in debt actually stimulates the economy. And if it stimulates it by financing investment, that's good. But if it stimulates by financing a Ponzi scheme like your housing bubble, that's disastrous. So the minority school I come from is called post-Keynesian economics, not new Keynesian. All the little, but we actually understand what Keynes said. We read Paul Krugman when I made a comment he didn't understand Minsky or Keynes. His answer, and he wrote it in the New York Times, was "I don't care what so-and-so and so-and-so meant, including Keynes," and they have the hide to call themselves new Keynesians. So it is a mess, mate. It makes religious wars look fairly precise and neat and tidy.
Before we finish up, I said at the start you were one of the few economists to have predicted the global financial crisis. Is there any prediction coming out of Steve Keane as to the global economic recovery?
Again, the only way we're going to go to the recovery is by reducing the levels of debt, private debt, which is the main worry. Public debt is basically a band-aid over the problem caused by private debt. And what happened in the Great Depression, it took from 1930 to 1945 to get that debt level down to the stage where it was so low that a boom began again. So that was 15 years. We had, rather than having a peak level of debt when the crisis began, it's 175% of GDP, which was America's debt in 1930, it was 300%. In England, it's 450% of GDP. So the length of time it'll take you to pay that down is measured in decades rather than years if we rely upon the standard process of bankruptcy.